Airlines today pack planes to the brim, charge for every extra bag, and sometimes leave passengers squeezed next to a crying toddler in a seat that cost an extra $100. Air travel, once a glamorous experience with complimentary cocktails and even in-flight piano performances, now feels like a relentless push to maximize profits. How did this happen? To understand, we must travel back to the late 1970s, when a single decision reshaped the airline industry forever. Deregulation in the United States allowed airlines to set their own routes and prices, sparking fierce competition. This chaos birthed a revolutionary idea: airline loyalty programs. These programs, starting with American Airlines' AAdvantage in 1981, transformed not just how people fly but how airlines survive. Today, loyalty programs are so vital that airlines like United, Delta, and American are worth less than the virtual currencies they created. This is the story of how airlines became banks that just happened to fly planes, and why they cannot survive without loyalty programs. In the late 1970s, American Airlines was losing its grip on the market. Deregulation, passed in 1978, unleashed a wave of new, smaller airlines offering cheaper fares. These upstarts chipped away at the dominance of legacy carriers like American, United, and Delta. Passengers began choosing lower prices over brand loyalty, and American needed a way to keep customers coming back without slashing fares. The airline turned to a small team, led by visionary chief executive Bob Crandall, who partnered with consultant Hal Brierley. They drew inspiration from an unlikely source: price stamps, small rewards collected at stores for purchases, redeemable for items like watches or cameras. What if airlines offered something similar? Instead of stamps, they could give miles, points earned for flying that could be traded for free flights. This simple idea became the AAdvantage program, launched on May 1, 1981. The goal was clear: reward frequent flyers to keep them loyal to American, even if it meant paying a bit more. American Airlines knew its average customer flew about 40,000 miles a year. To encourage more travel, they set a benchmark of 50,000 miles for a free flight, urging passengers to concentrate their trips with American. Tracking these miles, however, was a challenge. Computerized reservation systems were new, and airlines struggled to identify repeat customers. Was the Tom Jones flying from Miami to New York the same Tom Jones who flew to Paris last month? To solve this, American linked its reward and reservation systems, assigning each customer a unique number, an idea borrowed from rental car company Avis. This allowed the airline to know exactly who its most profitable customers were and tailor incentives to keep them flying. The program's early success was staggering. American expected 500,000 sign-ups in the first year but enrolled 1 million. Competitors scrambled to catch up. United launched its Mileage Plus program within a week, and by September 1981, nearly every major airline, TWA, Continental, Northwest Orient, Braniff, and Texas International, had a loyalty program. American's year-long head start gave it an edge, signing up customers while others were still figuring out how to track miles. The evolution of miles as currency. Initially, AAdvantage was a straightforward deal: fly enough miles, get a free flight. The cost of giving away a seat was low compared to the extra business it attracted. But the game changed when United removed the one-year expiration limit on miles, forcing American to follow suit. Without a time limit, passengers joined every program, diluting the loyalty effect and straining the economics. Airlines responded by creating tiers, like American's Gold program for the top 2% of flyers, offering perks such as complimentary first class. These upgrades were not just rewards. They accustomed flyers to premium seats, encouraging them to pay for them later. By 1982, American took a bolder step, partnering with Hertz and Holland America to let customers earn miles for renting cars or booking cruises. This was no small change. American began selling miles to these partners for about 1 cent each, covering the cost of redemptions and turning a profit. For a typical domestic flight requiring 25,000 miles, American earned about $250 from partners, while the variable cost of flying that seat was only $15. The math was clear: miles were becoming a currency, and airlines were printing money. The rise of co-branded credit cards. The real turning point came in 1987, when American teamed up with Citibank to launch a co-branded credit card. For every dollar spent on the card, customers earned 1 advantage point. This shifted loyalty programs from rewarding flights to rewarding spending. Airlines began selling vast quantities of miles to banks, who offered them as rewards to cardholders. United partnered with Chase, Delta with American Express, and the trend spread globally. This was a game changer. Airlines no longer relied solely on ticket sales. They were earning revenue from every swipe of a co-branded card, whether for groceries, gas, or gadgets. By 2018, American Airlines was losing about half a cent per mile flown, with passenger revenue of $14.42 per seat per mile against operating costs of $14.85. Yet, the airline posted $1.9 billion in pre-tax profits, thanks to $4.2 billion from its AAdvantage program. In 2023, American earned $5.2 billion from credit card partnerships, while Delta brought in $6.6 billion. Loyalty programs had become businesses in their own right, often more valuable than the airlines themselves. The true scale of this transformation became clear during the COVID-19 pandemic. With travel halted, airlines were bleeding cash. United sought a $5 billion loan in 2020, but its market value was only $10 billion, making it hard to offer enough collateral. Instead, United offered its loyalty program, Mileage Plus Holdings LLC, valued at $21.9 billion based on its 2019 earnings. Delta valued its SkyMiles program at $26 billion, and American pegged AAdvantage between $29.5 billion and $31.5 billion. These figures dwarf the airline's market capitalizations: Delta at $20 billion, American at $6 billion. Wall Street essentially saw the airlines as worthless, or even having negative value, without their loyalty programs. This was not just a quirk of the pandemic. Even in 2018, before travel collapsed, the numbers showed airlines were loss leaders, propped up by the virtual currencies they controlled. Airlines today are less about transportation and more about financial engineering. They operate like central banks, controlling the supply of their own currencies, miles, and deciding how they can be spent. Unlike national banks, airlines are private companies with unchecked power to create and sell miles at will. They sell these miles to credit card companies and partners, who use them to attract customers, while airlines pocket the cash. The average value of a mile, based on estimates from travel and finance websites, is about 1.218 cents for Delta SkyMiles, 1.226 cents for United Mileage Plus, and 1.416 cents for American AAdvantage. Higher valuations, like American's, incentivize customers to choose their flights and cards, driving more partner purchases. With only 3 major long-haul airlines in the United States, American, Delta, United, they hold leverage over partners like Citibank, Chase, and American Express. If a bank balks at paying more for miles, airlines can switch to competitors like Bank of America or Barclays, eager for a major airline partnership. The tax and policy advantaged loyalty programs thrive because of favorable tax and corporate policies. Miles are not taxed as income, treated instead as rebates, like a discount on bananas at the grocery store. This saves customers and airlines billions. Most frequent flyers are business travelers, earning miles on flights paid by employers. The miles go to the individual, not the company, acting as a tax-free perk. Companies tolerate this because it motivates employees to travel, boosting business. This setup creates a subtle incentive. Employees might choose pricier flights to earn more miles, spending company money for personal gain. Yet, most firms see this as a small price for loyalty. The result is a system where airlines, customers, and partners all benefit, while governments and companies foot the bill indirectly. Apple's early loyalty programs had flaws. Miles were earned based on distance flown, not money spent, leading to exploits. A 400-mile flight from Washington, D.C. to Nantucket cost $98, while one to Boston cost $49, yet both earned the same 400 points. Savvy travelers could book long, cheap itineraries, like Los Angeles to San Francisco via Chicago, to rack up miles at low cost, sometimes earning miles worth more than the ticket. This was bad for airlines, as it increased operating costs and redemption liabilities. Over the past decade, American, Delta, and United shifted to revenue-based systems, awarding points based on dollars spent. American, for example, gives 5 points per dollar. This eliminated exploits, ensuring airlines profit on every booking. On the redemption side, airlines moved to dynamic award charts, where mile costs rise with cash fares. A United flight from Newark to Denver costs 8,300 points on a low-demand Tuesday but 22,200 points on a high-demand Sunday, mirroring cash prices of $114 and $254. This closed the gap between mile and cash value, making arbitrage impossible. The challenges and scrutiny of loyalty programs are not without critics. In 2024, the Department of Transportation launched a probe into the 4 largest programs, questioning if they are unfair, deceptive, or anti-competitive. Consumers complain about devaluations, where airlines raise the miles needed for flights or lower mile values, making rewards harder to use. A flight once costing 12,500 points might now require more on peak days, frustrating customers who feel cheated. Airlines insist they want customers to use miles, arguing that engaged users drive more business. Yet, McKinsey research shows loyalty programs' influence on flyer behavior dropped between 2017 and 2021, and again by 2023. To stay relevant, airlines are expanding where miles can be earned and spent, from hotel stays to dining, aiming to keep customers hooked. But changes carry risks. Overhauls can alienate loyal flyers, forcing airlines to tweak programs carefully to avoid backlash. Loyalty programs. Airlines are now in a constant balancing act. They must keep loyalty programs attractive to customers and partners while by 2022, ancillary revenues like seat upgrades and baggage fees, tied to loyalty perks, made up 15% of total airline revenue. The average profit per passenger is just $13, but loyalty programs and co-branded cards fill the gap when flights lose money. Airports are filled with ads for credit cards offering free checked bags or lounge access, and flight attendants pitch cards at 30,000 feet, hoping for commissions. Priority lanes and elite status perks make flying feel like a curated experience, nudging passengers to join programs. As competition grows, airlines are exploring new ways to spend miles, like unique experiences or non-travel rewards, to keep programs fresh. The risk is overcorrecting, as some airlines have made changes only to roll them back after customer outcry. The future of air travel hinges on these programs, which have turned airlines into financial powerhouses, where flying is just a means to fuel a multi-billion-dollar currency empire. What began as a simple idea to reward frequent flyers has reshaped the airline industry. American Airlines AAdvantage, born in 1981, sparked a revolution that turned airlines into financial giants, printing virtual money that powers their survival. With loyalty programs valued higher than the airlines themselves, $21.9 billion for United, $26 billion for Delta, up to $31.5 billion for American, these carriers are no longer just about getting people from one place to another. They are banks, controlling a currency that drives consumer behavior and corporate profits. From co-branded credit cards to dynamic pricing, airlines have built a system where they cannot lose, backed by tax breaks and corporate policies that amplify their power. As passengers navigate packed planes and rising fees, the loyalty program remains the invisible engine keeping airlines aloft, proving that in today's skies, miles matter more than wings.